Okay, today's lecture is going to be on capital budgeting, and I have previously uploaded a series of handouts and notes and pages from the textbook up onto Sky. So I'd ask that you have that information in front of you if it's possible. I will go through it as best I can. So capital budgeting. And as part of capital budgeting, we need to have a good understanding of the time value of money. So what is planning for capital investments? Well, capital investments mean it's a significant investment, okay? A capital investment, think of a capital asset, think of a long-term asset. From managerial accounting and from financial accounting more specifically, there was a whole chapter on long-term investments, property, plant, and equipment. And that is essentially what we're talking about here is long-term investments. That is investment that will pay back over a long period of time. This is not a one-year payback. These are investments that will be providing a long-term cash flow over several years, has a useful life of many years more than one. And when we evaluate this investment, we're going to be looking at two methods in this chapter. We're going to be looking at the cash payback method, and we're also going to be looking at the net present value method. Specifically, we're going to be looking at two things. Number one, we're going to look at the initial cost of the investment. What is the outlay of cash to be involved in this project? And secondly, and probably more importantly, we're going to be looking at the cash flows that are associated with this investment. Let's imagine, I think the textbook talks about, let's talk about a cruise ship. Many of you have probably been on a cruise ship. They are significant investments. As a matter of fact, Royal Caribbean has, in the last several years, purchased a cruise ship that costs $1 billion, $1 billion. That's not million with an M, that's billion with a B. And their investment, the cost of that investment is $1 billion. Why would a company invest $1 billion in something? Well, to make money. And what money is there to be made? Well, that cruise ship is going to have cash flows. There's going to be revenue that comes in from that ship. Customers booking rooms, customers having spa treatments, having beverages, buying booze, taking excursions on that trip. So there's going to be revenue collected on that ship during the year. And secondly, there's going to be cost. There's going to be expenses associated with that. So ideally, there is a net annual cash flow, revenues collected less expenses paid. So we're interested in two things when we're looking at capital investments. The initial cost of the investment, which usually occurs up front at the very beginning. And then over the useful life of that investment, there is a return on investment. More specifically, is an annual cash flow. So we are also need to understand the time value of money. And the reason the time value of money is important is because on an annual basis, there's going to be a net annual cash flow. But those cash flows are going to happen over a period of time. When the company invests in this new cruise ship, they're going to pay $1 billion today. They're going to invest $1 billion today in the present. That cruise ship may be operational. The useful life of that cruise ship may be 15, 20, 25 years. So the question is, what are the cash flows over the next, let's say, 20 years? There's going to be cash inflows and there's going to be cash outflows. And in order to properly evaluate it, we need to understand the time value of money, and we need to understand that a dollar 10 years from now is not worth $1 right now. It's worth a lot less. I have an example. Let me share this screen. And what you'll see here is, again, this is what was loaded up onto Sakai, and specifically planning for capital investments. This is lecture 1 from this chapter, and we're going to be talking about the cash payback method versus the net present value method. So the next sheet here is sort of a handwritten analysis. And what does it say? Here's an example of the time value of money. Let's assume that we invested $1,000 today on January 1 of any particular year. And we're going to let that $1,000 sit there for 5 years. And that investment is going to earn 10% interest per year. So $1,000 invested today is going to earn 10% a year. We're not going to add any new money to it except for the interest, and we're not going to withdraw any of the money. Question is, at the end of 5 years, how much money will be in the account? Time value of money. Now, you can see on the screen here what I've done is I've made year 1, January 1, we have initial investment here. Follow my cursor if you can. The initial investment of $1,000. At the end of that year, we're going to earn 10% of $1,100. On December 31st, we're going to have $1,100. That carries over to the balance at the beginning of the second year. At the end of the second year, we're going to earn 10% on that $1,100, have $110 worth of interest. The new balance is $1,210. Third year, we start with $1,210. We get another 10% interest, $121. The ending balance is $1,331. We carry it all the way to the end of year 5. We have a balance of $1,610. So what that means is that we invested $1,000 on day 1, January 1. At the end of 5 years, on December 31st, we have $1,610. That means we earned $610 time value of money. So $1,000 today is worth $1,610 5 years from now. More importantly, $1,610 5 years from now is worth $1,000 today, assuming it's invested for 5 years at 10%. Now, it takes a little bit of time to work out this analysis. So there are some formulas that we can use. So we say to ourselves, if we deposited, if we had $1,610 5 years from now, what is it worth? Well, we just showed you it's worth $1,000, but there are tables, there are financial calculators that will help us. So this type of a cash flow is the present value of a single payment. So PV of 1, where the interest rate is 10%, the number of periods is 5. There is a factor from a table, which we'll see in a minute, the factor of 0.62092. So if we know we're going to have a cash flow of $1,610, whether it goes out or in is irrelevant, but we know we have a cash flow 5 years from now, and our discount rate is 10%. The question is, what is that worth right now? It's worth $1,000 in present day dollars, as we saw from that calculation, but more importantly, there's a factor here. So at the very end of the Sakai handout I gave you, and I'll go to the very end of it, is a table here. There's 2 tables: present value of $1, present value of an annuity. We'll talk about an annuity later. Here we have, because that payment of $1,610 is a single payment, that's a present value of a single payment, PV of 1. And we want to know what that $1,610 is worth today. So we look at the interest rate. We have 10%, and we know it's invested for 5 years. 10%, 5 periods. Factor we want to use is 0.62092. So we come up, and that's where we have this factor right here. We take the future value is $1,610. We want to know what that's worth today. That's worth $1,000 today if it's invested for 5 years, and the annual interest rate is 10%. That's the time value of money. So what we want to look at is a couple of examples here. The first thing we want to talk about is cash payback. The cash payback method is a very simple method. The cash payback method takes the initial investment and divides it by the annual cash flow, and that will tell us what the payback is in terms of years. So we have an example here. This is a brief exercise BE 25-1, and it's Rahana Company is considering purchasing new equipment for $450,000. So that's the capital investment. It is expected that the equipment will produce net annual cash flows of $60,000 over a 10-year useful life. Annual depreciation will be $45,000. Compute the cash payback method. So under the cash payback method, we ignore the time value of money. We'll see what in that in a few minutes. The cash payback method simply takes the annual investment and we divide it by we take the investment, the capital investment, which occurs once, and we divide it by the annual cash flow. And that tells us what the payback is in years. We ignore non-cash expenses. Depreciation is a non-cash expense. So again, Rahana Company is considering purchasing new equipment. That's a capital investment for $450,000. It is expected that the equipment will produce net annual cash inflows of $60,000 over its useful life of 10 years. It simply says compute the cash payback period. So I have that calculation right here. And it says brief exercise 25-1, cash payback, the initial investment of $450,000 divided by the net annual cash flow of $60,000. It takes 7.5 years, 7.5 years for it to pay back, to break even, if you will, which is what? If the useful life is 10 years, it's 75% of the asset's useful life. It takes 75% of the useful life for it to pay back. Now, should the company accept it or reject it? Should they go forward? Well, we don't know because we don't know what the company's policy is. We don't know. Oftentimes their policy is, if it's cash payback method, they say it has to pay back within a certain number of years. Here we don't know that. It's just a very simple problem asking you to calculate cash payback, and all you need to know is the investment divided by the annual cash flow. 7.5 years is the answer. Let's look at another exercise. Let's look at brief exercise 25.2. Some company accumulates the following data concerning a proposed capital investment. Cash cost, $215,000. That's the capital investment. Net annual cash flows, $40,000. And present value factor of cash inflows for 10 years is 5.65%. Determine the net present value and indicate whether the investment should be made. So here we have a slightly different problem. And this is the net present value calculation. And the net present value, which we're going to talk a little bit more about it later, is saying you need to have a positive or a zero net present value. Net present value, we want to take a look at all of the cash flows associated with that investment, cash inflows and outflows. We want to look at them in present value dollars and calculate the net present value. A positive net present value we would accept the project. A 0 net present value would also mean we accept the project, because that means that the rate of return on the project is equal to the company's minimum required rate of return. If there is a negative net present value, company will reject the project because the return on investment is less than the company's required return. So in our example here, the company has an initial outflow of $215,000. That's the initial investment of the project. It's an outflow of cash. It's already stated in present value dollars. There is an annual inflow, happens on an annual basis, $40,000 per year. But what is that worth? Well, it's not 40,000 times 10 years at 400,000, because that $40,000 comes on an annual basis. You get 40,000 in year 1, 40,000 in year 2, 40,000 in year 3, happens over 10 years. What is it worth today? Well, the way we want to look at this is we're going to look at a table that's going to give us a factor. We need to know two things. What type of a cash flow is it? Well, it's an annuity because it happens on an annual basis. It doesn't just happen once, it happens on an annual basis. It happens for 10 years, so N, number of periods, is 10 years. And the company's interest rate, the discount rate, is 12%. So if we were to look for the table, we go to the very end of this handout I gave you guys. And we're not using the present value of a single payment because it happens on an annual basis. So we're going to use the present value of an annuity. That $40,000 payment happens on an annual basis. And it said that the interest rate was 12%, and it happens for 10 years. So they have a factor of 5.65022. That's the factor that they gave you. That's the factor we are going to use to discount that cash flow. So again, $40,000 times 5.65% gives the present value of that $40,000 a year for 10 years is worth $226,000. The net present value, we have an outflow of $215,000, we have an inflow of $226,000, we have a net present value of $11,000. Company's recommendation is they should accept and go forward with investment because the net present value is positive. Okay, let's look at another problem. Now there's a lot of pages here, but it boils down to a very straightforward problem. But let's start with, this is the Stewart shipping example. And again, I've kind of given you this information. So to compare the results of the various capital budgeting techniques, we use a continuing example. Assume that Stewart Shipping Company is considering an investment of $130,000. So the initial investment is $130,000 in a new piece of equipment. The new equipment is expected to last 10 years. That's the useful life of the project. It is estimated to have 0 salvage value at the end of its useful life, so it's worth nothing. The expected annual cash inflows are $200,000, and the annual cash outflows are $176,000. So the revenues are $200,000, the expenses are $176,000. So this chart right here summarizes the investment. The initial investment, $130,000, useful life 10 years, and you can see the net annual cash flow is $24,000. So the question is, should the company go forward with the investment? They're trying to make a decision. You know it's $130,000. We know it lasts 10 years, and it's going to have a net annual cash flow of $24,000. Should they go forward with the project? So the first item they want to look at is the cash payback method. Again, there's two methods that we're looking at here today. We're looking at the cash payback method, and we're looking at net present value method. It depends on which policy, which method the company uses to make the decision. The first one that they want you to look at is the cash payback technique. Cash payback technique identifies the time period required to recover the cost of the capital investment from the net annual cash flow produced by the investment. The 25-4 illustration presents the formula for computing the cash payback method, assuming equal annual cash flows. Here's the formula for the cash payback method, which we talked about a few minutes ago. Cost of capital investment divided by the net annual cash flow equals the cash payback period in years. There's no concept, there's no recognition of present value here. They just use whatever the dollar is. So here you can see the initial investment is $130,000. They're going to divide it by the net annual cash flow of $24,000. It takes 5.42 years for it to pay back. The evaluation of the cash payback period is often related to the expected useful life of the asset. For example, assume that at Stewart Shipping, a project is unacceptable if the payback period is longer than 60% of the asset's expected useful life. The 5.42 year payback period is 54.2% of the project's expected useful life. Thus, the project is acceptable. So if the company was using the cash payback method to make a decision on whether to go forward or not with the project, they would accept it because it is less than 60% of the useful life of the investment. I'm going to let you read some of that on your own. I have a summary illustration, which we'll refer to here at the end of the document. And this is a handout here. So this is something I put together again that summarizes the Stewart Shipping Company. Again, this is a summary which you just saw before. The investment opportunity, $130,000. Estimated useful life, 10 years. Estimated annual cash flows, inflows, $200,000. Outflows, $176,000, net 24. Using the cash payback method. Again, the initial investment divided by the cash annual cash flow of $24,000. The cash payback period is 5.42 years. Company's policy. Project is unacceptable if the payback period is longer, unacceptable if longer than 60% of the asset's expected useful life. The asset's expected useful life was 10 years. You calculated 5.42 years. Payback is 54%. It's less than 60%. Your recommendation would be to accept the investment, go forward with the investment, if the company was using the cash payback method. Now, the second method that we talked about is the net present value method. Again, we saw that brief example. But in the net present value method, we need to look at all of the cash flows. We take the net present value of the inflows. We take the outflows, we take the inflows at present value, subtract the outflows at present value. If we have a positive number, we go forward. If we have a zero, we go forward. If we have a negative number, we reject. And I'm going to go back to the reading here. And there's a nice chart in here that explains it to you. It's right here. So here it is, the present value of the net cash flows. Net cash flows. The inflows minus the outflows in net. Less the investment, what do you get? If zero or positive, you're going to accept it. If negative, you're going to reject it. Go back a little bit here, so there's a discussion here. So here there's a nice discussion about the net present value. Let's read it. The net present value method involves discounting net cash flows to their present value and then comparing that present value with the capital outlay required by the investment. The difference between these two amounts is referred to as the net present value. Company management determines what interest rate to use in discounting the future net cash flows. This rate, often referred to as the discount rate or the required rate of return, is discussed in a later section. The net present value decision rule is this: a proposal is acceptable when net present value is 0 or positive. A 0 positive NPV indicates that the rate of return on the investment equals or exceeds the required rate of return. The required rate of return is management's minimum acceptable rate of return on investment, sometimes called the discount rate or cost of capital. When net present value is negative, the project is unacceptable. And we just saw illustration 25-6 shows the net present value decision criteria. We just looked at that chart. So let's go back to the Stewart Shipping Company. Now, this worksheet that I've included here is a summary of the material that's in the chapter, so feel free and go back and read it. But here now we're looking at Stewart Shipping. We're more concerned, again, please try to follow my cursor here, the net present value when there are equal annual cash flows. Again, the company's discount rate is 12%. The present value of the cash flows is $135,000. Well, how did we get that? So what they did is they took $24,000 and they found a discount rate. So they have this useful life is 10 years. And this is a cash flow that happens on an annual basis. So N is 10 years. Interest rate I is 12%. So we need to find a factor. So we're going to go to the end of this handout. And this is an annuity because this $24,000 occurs on an annual basis. The discount rate is 12%. And it happens for 10 years. The factor is 5.65. 5.65022 times $24,000. So I didn't write it on the handout, but what's important here, the way we came up with this present value of cash inflows is you took the annual cash flow, the annuity of $24,000, and you went to the PV of an annuity table, and you looked up a factor where the interest rate is 12%, the number of periods is 10, and you find a factor of 5.65022. You take the $24,000 of annual cash flow, multiply it times 5.65022, and you come up with 135,605. What that's telling you is that annual cash flow is worth 135,605 right now. It's not worth 240,000. It is not worth $24,000 a year times 10 years right now. That's what it's worth in the future. We want to know what that $24,000 each year is worth right now. It's worth 135,605 present value. Present value of the inflows is 135,605. The present value of the outflows, the capital investment, $130,000. they have a net present value of 5,605, positive present value. That means that the rate of return on the project itself is greater than the company's minimum required rate of return. The company's minimum required rate of return right now is 12%. Because you have a positive net present value, the rate of return on the project is greater than the minimum required of 12%. Therefore, the company is going to approve it. A zero is also acceptable. A net present value of zero is acceptable because the rate of return on the project is exactly equal to the company's required minimum rate of return. If they have a minimum rate of return of 12%, the net present value is zero. That means it's equal. They go with it. If the company had a net negative, if it had negative net present value, that means the rate of return on the project is less than the company's required minimum. Therefore, they would reject it. So in the first part of this problem here, again, we assumed that they had equal annual cash flows of 24,000. So I said to myself, what if instead of equal annual cash flows, that the cash flows were unequal? So let's remember, in the first part of the problem, they had equal annual cash flows of $24,000. Over 10 years, they would collect $240,000. So I said, what if they were unequal? So you can see in this handout here, the lower left-hand corner, I said NPV, unequal cash flows. And here I've given you the years 1 through 10. And you can see the cash flows are unequal. Year 1, 34,000, year 2, 30,000, year 3, 27,000. You add all these numbers up, they still come up with $240,000, but they're unequal. So the question is, how do I evaluate this? How do I evaluate this investment? So I still need to take the present value of the annual cash flows. The problem is I can't use an annuity anymore because it's not equal and annual. In order to use the PV of an annuity table, the cash flows have to be equal and annual. In our example right now, they're annual, but they're not equal. So we need to use a different table. We need to take the present value of each one of these cash flows and treat them as if they are the present value of a single payment. So here I've got the factor for you here. This is PV of 1. Well, where does the PV of 1 come from? It comes from this table here, present value of $1, present value of a single payment. The interest rate is still 12%. So let's look at this information right here. We've got 10 periods right here, 12%. We've got year 1, year 2, year 3, year 4. So these numbers right here, starting with 0.89286, and then 0.79719. I put those numbers right here, PV of a single payment. So year 1, $34,000 times this factor gives me the present value of the $34,000 is $30,000. Year 2, I collect $30,000, factor here, and you've got 23,916 is the present value. We add up all the present values of those cash flows, we get 144,000. So again, NPV, calculate net present value. Present value of the cash flows is 144,000. The capital investment is 130,000. Net present value 14,367. Still positive. Because it's positive, you want to accept it. So on the right-hand side here, I flipped over the cash flows. Again, these cash flows are unequal, but annual. So all I did is I took the same cash flows as to the left here, I just put them upside down and took the calculation. Again, still a total of $240,000, but the cash flows occur in a different manner. They are unequal, but they're annual. Still need to use the same present value factors. If you look closely, they're exactly the same ones on the one on the left. Same number, 12%, years 1 through 10. But you have a different cash flow. 18,000 in year 1, not 34,000. 20,000 in year 2, not 30,000. Take an annual cash flow, multiply times the factor. You have the present value. We're going to total all those present values up. Present value of the cash flow is $127,000. The capital investment is still $130,000. But look what happens here. You have a negative net present value. So remember, a negative net present value means that the rate of return on the project is less than the company's required minimum. In this case, the company's required minimum is 12%. It doesn't meet 12%. They're going to reject the project. So I would ask you to look through this information. Again, in terms of what we have here, we have simple analysis of time value of money. We have two very straightforward problems. One is capital is the cash payback method. The second one is net present value. Here are the solutions for those two basic exercises. Here is some reading that I'd ask you to do with regard to cash payback, net present value, which focuses primarily on Stewart shipping. And then I have my one page here, which is a summary of Stewart Shipping Company using cash payback, then net present value, an annuity, and then unequal cash payments. I'd ask you to look at them and be familiar with the two tables. So there is the discussion on lecture number 1 from capital budgeting. Please take the time to review it, and thank you very much.